In the next edition of It's About Money, we'll be talking about good debt and bad debt, and the good folks from the Consumer Credit Counseling of Rochester will be my guests. Welcome to another edition of It's About Money. I'm Nannette and thank you for joining us. I'm thrilled that our guests today are Chad Reiflin from the Consumer Credit Counseling of Rochester, and he is the Program Coordinator and Grants Coordinator. Is that right?
Correct.
Thank you for being here again, Chad. Chad is our annual guest, so I'm glad that he's here. And Andrea Colline is also here, and she is the Program Coordinator, right, for Outreach. Wonderful. Thank you both for being here. In the last couple of years, there's been a lot of press about school loans being a bigger type of debt than consumer loans. So to me, I don't think it's alarming because I believe education is an investment. But talk to me about what kind of debt that is. I mean, education and credit cards. Is that a good debt, a bad debt?
Right. How does someone distinguish a good debt versus a bad debt?
Right.
Yeah, that could be a difficult question to answer. I think any debt could turn into a bad debt if it becomes overwhelming, or if someone has not prepared themselves to enter into that type of debt, or maybe didn't understand the terms of that debt. But generally speaking, we talk about good debt versus bad debt. I think what we're talking about is this money that we're borrowing for something that's really going to help us enhance the values of our lives, help us to build things that are truly valuable, versus borrowing money for things that expire quickly, using credit cards to buy food or to buy things that are perishable or really are not going to help us to amass assets and value in the end.
So really it's about the purpose of the debt and then the ability to repay the debt. Because you can use your credit card at the grocery store, but if you pay it at the end of the month, it's not so bad.
Right.
Right. Mm-hmm. So, okay.
Yeah, I think that's probably a really good way to sum it up. The purpose of the debt and the terms.
Yes, absolutely. Right. Thank you. It's nice to be able to differentiate that. So if someone had the ability to pay cash for something, do you ever is there a time where debt is better than paying cash for something?
Well, it depends on what the individual's goals are and what they're trying to reach. Paying cash, I feel, is a good strategy in respect to spending less money. But most individuals are going to want to purchase a vehicle or purchase a mortgage or, purchase a home at one point or the other. So using credit really should be where someone's just trying to build their credit history and just trying to enhance their credit report, just to show, yes, I am responsible. Yes, I know how to repay some bills. It's just purely so it shows up on your credit report. If we all use credit just like that, we all have great credit.
Yeah, you're absolutely right, because I have met people who've never borrowed money, and when they need to get a credit card because they're beginning to travel, it's hard for them to get it because they have no credit history and they can't get a good score because there's not enough history there, right? So a good point. You're absolutely right. Again, it's the purpose of it and the terms of it. Yes, very good. So what are the primary reasons why consumers' credit score get marred? So help me actually first define the credit score and what makes consumer botch up their score.
Okay. Well, maybe I'll talk a little bit about credit scores, and then Andrea can talk a little bit about, some of the things that we've seen that people maybe do that they want to avoid with their credit scores. Credit scores are very complex and probably far more detailed than people realize. There are a vast number of credit scores that people could purchase online. We most commonly think of FICO scores, which was one of the originally created credit scores that most lenders still use today. And that credit score is a specific model, it's a specific formula that is used to evaluate someone's likeliness to repay. The way that formula works is it's a comparative, and it actually compares our credit report to a model that they create from thousands of different credit report samples across the country. When our credit report looks a little bit better in those particular areas of the model, then we'll earn points in those areas. When it doesn't look as good, then we'll lose points. Generally speaking, with a FICO score, if someone's score is in the range of maybe 740 or higher, then they are in the excellent position where they're going to get the best interest rates on loans.
And the top being 800?
Top for a FICO score would be 850. but which FICO scores usually range between 300 and 850. But again, there's other different credit scoring models that utilize a different scoring range. So that exact number can be a little bit different as far as what someone's target is. But the things we would want to do to maintain a good credit score are generally the same.
And actually, we'll touch on that score first. So even though someone has resources, if they're not paying on time, that's not part of the ability to pay. So it could reduce their credit score, right? So someone might have all the money in the bank or in investments, but if they're not paying on time, that doesn't enhance your ability to pay for that debt.
That's actually the thing that will hurt your credit more than anything, is having a 30-day delinquency appear upon a credit report. In my experience, it doesn't even matter how much an individual earns. You can earn a very high income, have a lot of money in savings, and have a lot of assets. But if you fall over 30 days delinquent on a credit report, your score can really drop, especially if it's high to start with. You can lose 100 points in some circumstances, if not more. So it's really can damage your credit report.
The higher scores tend to lose more with negative activity than lower scores. Because the thought is, if your score is lower, then it's already an indicator that you're not doing so well.
I see.
So
So
if something
into the
happens
formula.
that would be negative, then it's just kind of already in the course of business. But like Andrea was saying, if you're in a really good position and then you have a 30-day late payment, that's so much more alarming that would take place and you can fall really fast.
So you really have to place a lot of value if you have a good credit score, for anybody, but specifically those individuals. Okay.
Yeah, you always lose points a lot faster than you earn points, unfortunately.
I see. Okay.
And it's just kind of the nature of the system.
And now there are agencies where consumers can, or websites, I should say, where consumers can get their credit scores, right? Can you talk about that a little bit?
Sure. The most popular one that we recommend is annualcreditreport.com. Annualcreditreport.com is the website where you can get your credit reports for free once a year. So there's 3 agencies. You can get one from each agency per year for no cost. That does not come with a credit score. The credit score, I believe, is $7.95 per agency that you pull from, but you can get your free credit score, or I'm sorry, your free credit report.
From those. So ideally, if you want to monitor if someone's hacking your information, you can check every 4 months.
Absolutely.
And get it free. Okay.
Perfect.
Now, when I download my score, what do I do with it? What should a consumer do when they look at their report? What are the key items to read from there?
I think one piece of information that folks should really be aware of when it comes to this issue of credit scores and buying their credit score online is that they are never purchasing the same credit score that a lender purchases when they buy their credit score online.
That's very important. Okay.
Yeah, the reason is because lenders purchase a specific version of that credit score that aligns with their type of lending. So even with the FICO score, there's different versions of that for mortgage lenders, for auto lenders, for credit card lenders. So when they create credit scores for general consumer purposes online, it's more of like a generic version of your credit score. So it'll be close, but it won't be exact to what it might be if you were to go and apply for a loan and they show you what your credit score is.
I see. Okay. So it can be deceiving. You could have a high score generally, but they look at specific.
Right. So when you're buying it online, you're still always just buying kind of a ballpark figure. And there are some free resources that people can use to get a free estimate of what their credit score would be.
Okay. And are those non-for-profit or are they for-profit?
A lot of them are attached to for-profit websites, but many of them are calculators. So they're like evaluation tools where you respond to certain questions about what you know is in your credit report, and it gives you a free estimation. Many of them are anonymous. You're not putting any personal information in. So if someone were to just search credit score estimator or credit score calculator, they would probably find a lot of tools online that they could use.
Okay, sounds good. But let's say I requested for a report from annualcreditreport.com and I didn't pay for the score, and I print out the report and it lists all the credit cards or any other debts I've had before. What are the key things I should be looking at in that report?
Just to ensure that there's no delinquencies, make sure that nothing's gone beyond 30 days. Also to make sure that the balances are in line with what you owe currently upon your statements. and to really make sure that, things are where they need to be. Also, the dates that you opened the accounts. The longer you have that relationship with that lender or the bank or the credit card company, the better, really, because it shows that you can have a long relationship with them and still continue to make those payments on time. So it can really help to increase. Another thing to keep an eye out is for your inquiries. Inquiries will typically stay upon a credit report for 2 years. Anytime you pull or you apply for a credit card or something of that nature, your credit score can drop. So you really want to be careful not to have too many inquiries. That does not include you looking at your own report, but it does include mostly for credit cards. If someone's applying for too many credit cards in a specific period of time, the credit cards will show. Your credit report will show the inquiries for 2 years, but the negative impact is usually for the first year or so. It's not major unless you're trying to get a credit card every month, even 3 or 4 a year. You got to be careful of that. So that's why we have to be careful of applying for too much credit. But that's what I would really pay attention to if I was looking at a credit report without a score. Inquiries, delinquencies. Also, a big factor is how much debt do you have in comparison to your limits. One key that I've utilized over the years and referred people to utilize is never go more than 30% of your limit. If you tend to go too close to the limits, your score won't be as high.
I see.
So that's just something to keep in consideration. Individuals who actually use less than 20% of their limits on each card, or 0 to less than 20%, tend to have very high credit scores. So that's just something to consider when you're looking at that.
Now, so is someone who, holiday shopping, someone goes to the mall and applies for each of the big box credit cards. You just like, I get a free thing, whatever that
10%
offer
discount,
might be. Right, that's right. So that could be a negative if someone does that, right?
That would absolutely be a negative. It's specifically the credit checks, like Andrea was saying, from credit card applications that are the ones that will slightly reduce your credit score. And from what I've read in different research that I've done, it's because they've found that people who apply for a lot of credit cards in maybe a relatively short period of time are typically doing that because of some sort of financial difficulty.
I see.
So that's why they built that into the model. The misconception that's been developed over the years is that every time your credit's checked, it's going to lower your credit score. But as you just heard, that's not always the case.
God, it's the amount that you're applying for.
And the type of check.
Okay.
So our own personal checks would be considered soft inquiries. It's not actually a lender checking our report, so it doesn't have any bearing.
So talk about, let's say somebody applied for a big box or a big store credit card 20 years ago, but they've not used it after they got the 10% discount, using the holiday thing. Should they keep that card open, or has that generally been closed?
I would say yes, because if you've had a card open for that long of a period of time, if you close that card, depending upon the limit, your score can drop because your whole, how long your credit longevity is reduced.
I see.
So the longer of a history you have, the higher your score can tend to be.
I see. So if someone had applied to 8 different stores, keep the longest one there and possibly remove the others. Because, the other side of it is you have all these open credits. doesn't that increase the probability of fraud, right?
It could.
Yeah,
And
so,
it could
okay.
increase the probability of using your credit cards
Using
too
more-
much.
Yeah,
That's a good
right.
point. That's a good point. I guess once in a while, I meet people who've said, I've had this, and I'm not naming names, credit cards from all these different stores, but I've not used it in 20 years, so, but that's a good point. So maybe the cards in between, if you want to unload some of it, might be a good thing to do.
That's a common question that we get a lot, too. The way that the credit scoring models evaluate this particular component, which would be the longevity or length of time that our credit's been established for, is that it will evaluate the longest account that we've had open, and then the average age of all the accounts that we've had open.
I see.
So through eliminations or new accounts that have been brought on that are brand new, it's going to affect that average. That's how consumers would want to think about that particular issue.
I see. Okay, well, that's great. That's wonderful advice. I really appreciate that. What is the typical profile of a consumer who gets the top rating? You mentioned earlier, make sure you pay it. You don't be delinquent 30 days. So that's one. Are there any other items that tend to increase that score?
Well, they would probably have multiple forms of credit accounts on their credit report that show that they've been paid and paid on time.
Okay.
They would have history that shows that they've paid down balances and don't owe a lot compared to their credit limits, as Andrea was just pointing out. That difference between credit limits on credit cards and our balances is a very big factor, much larger than most people estimate. It's probably the second largest factor overall. The nice thing about that particular factor is that's something that's very changeable and affects our credit score much more quickly than other factors do. It would probably be someone who's had their credit established for more than 10 years. And it would probably be someone who has not had a lot of inquiries or new accounts opened within the past year.
I see. Okay. And then to speak of that, like recent graduates who have school loans, that helps them too, right?
It can, as long as they're paying them on
Of
time.
course, yes.
It actually can. It can help them in the matter that the debt that they owe is diverse, because diversification is part of your credit score as well. If someone owed $10,000, but it was all to credit card debt versus $10,000 and it was between a student loan, a credit card, and a vehicle, the person with the more diverse portfolio will tend to have a higher credit score. So that can definitely help as long as it's affordable.
And we define the credit score again as one's ability to pay back debt, right? On a
Correct.
timely
Yep.
fashion. Okay.
Report card.
Yeah, basically, right. So when you're borrowing money in the future, you get better terms, right?
Absolutely.
And I know that insurance companies use the credit report at times, or maybe more often than that, more than at times, in naming the premiums for the consumer, right? So if you have a poor credit report score, one might possibly be paying more for the auto insurance and all that.
They certainly would be. And there's some estimations that premiums could be up to 50% higher for folks who have credit scores that are not up to par. And again, it's through different research that's probably been done for a lot of the insurance companies showing that folks with lower credit scores tend to have driving histories that are not as well off as others.
Sure. And probably they don't pay their credit cards on time. They may not pay the premium on time.
That
So it
could
could
be
be,
too,
yeah,
yeah.
that's right, that's interesting. So you've been affiliated at the Consumer Credit Counseling of Rochester for a long time, right? You've been there a while, which is great for our community, for both of you. What does the agency actually do? What is the Consumer Credit Counseling?
Everything.
Everything. Make dinner too.
Our main goal and mission is to help individuals and families become sufficient with managing their finances so they can meet their goals as far as being homeowners, purchasing a vehicle, having good credit, not having too much credit or debt. We offer a multitude of services. One of the main services we offer is debt management counseling for individuals who maybe feel they're a little overwhelmed with debt, whether it's credit card debt, even if it's old, like utility debt, old cell phones, collection, medical bills. We can help them condense those payments into one where they would pay us and we would then pay the creditors, typically at a lower payment and lower rate in less than 5 years. That's what we're most known for, but we have a lot of other services beyond that. We also have a student loan counseling for individuals who are having difficulties repaying their student loans. We have a housing program. Encompassed in that is a foreclosure prevention counseling for individuals who are struggling in paying their mortgage payments. We have a first-time homebuyer program, specifically geared toward the First Home Club, which is a federally funded program that allows qualifying individuals to receive a grant toward their closing costs, but it's a matched grant. For every dollar they save, they get $4. So our role in that is basically to help the consumer, not just with the credit, I mean that's a big part of it, but to help them plan, for their budget. I mean that's a very important piece that we do is we help individuals look at their income, their expenses, and save appropriately in trying to stay out of debt. So that's really where we stand with the First Home Club, which is a fabulous program. We do reverse mortgage counseling. We don't give reverse mortgages, but we help individuals understand what's involved prior to obtaining that to make sure that they're making an informed decision. We also offer bankruptcy counseling. We don't file bankruptcies for individuals, but we help them through the process, especially to make sure that when they're completed with the bankruptcy, their credit can get back to where it needs to be little by little by little by just giving them the required education that they need. We have a multitude of different services and different programs out there.
And about a year and a half ago, we also started a new division called Balanced Care, which provides financial services to individuals with disabilities and seniors, and we're a licensed rep payee organization. So we're definitely glad that you asked that question, because I think a lot of folks, when they hear a credit counseling organization, they just think of helping people with debt.
Sure,
Too
like
much
trouble.
credit card
Yeah,
debt.
Yeah,
right,
and you hear a lot of commercials on TV for different companies that provide services like that. But originally, a lot of credit counseling organizations, such as ours, were started as grassroots nonprofit agencies that do far more to help folks just with this difficult issue that we all face in being able to manage our finances appropriately and having a handle on that and learning those things that we need to learn to build those capabilities in our lives that we all need to be able to reach our goals. So it's definitely something that we enjoy being able to do and being able to provide to the community.
That's great. So really seniors who may not have the ability to see their checkbook, the writing of it, write checks, balance their account, that could be something that you guys can help with. That's really
Absolutely.
good.
Yeah.
Absolutely.
And I like the first-time home buyers, but there's some income limits on that, right?
There are some income limitations on that, but they're pretty broad. I want to say it's about $56,000 annually. If an individual or family of two earns under that, they may qualify for the First Home Club.
No, what a great deal. There's a government program that helps them make that closing costs.
Yeah.
Fantastic.
It's a
Thank
beautiful
you.
program.
Thank you for sharing that. So what are the primary reasons do you think that debt becomes unmanageable for consumers? What gets them in trouble?
Well, there's the obvious reasons like loss of income. If someone unexpectedly loses a job and they had debt and they were using debt to manage certain aspects of their finances, then it's going to become difficult to repay that debt. Other life circumstances such as divorce or an illness. But we do see a lot of folks who just maybe got in a little bit further over their heads than they anticipated and maybe just didn't have an understanding as to how much of a burden that debt was going to place on them. So we do a lot of work to educate people to help them understand kind of proactively, here's how you want to approach this issue of taking on debts, that you don't take on too much, because it's easy to do, and there's a lot of push out there from folks who are very sincere in selling different products revolving around loans, etc. But as a consumer, you still have to be very careful and very informed and kind of strong in your stance as to how much you can afford.
Sure, right. So you're right. So I actually always recommend for people to have 6 times expenses in a cash reserve position in case of a loss of a job or some unforeseen circumstances. So if you are actually making a good living and then still relying on credit card when troubled times come, trouble comes, it makes it more difficult to manage, right?
Most definitely, and there's always those 2 main issues that we all face, which is being able to control our expenditures and making sure that doesn't exceed our income. So that's why the whole budgeting component is so important, although we don't like to talk about that in our culture. And money is the least talked about topic in our culture. Right. But it's important to understand how we relate to money and how we can maintain that control. Sure. And then the second issue is there's always going to be something unexpected that happens. Maybe even not to the level of losing our job, but something that needs to be fixed or just some sort of circumstance that popped up that created an additional expense. So the second thing we always have to do is have that emergency savings.
Sure, and actually the more we own, the more likelihood that there would be things that break down that we'd have to fix, right?
Right.
So it could be a small amount or it could be a substantial amount of financial burden for people, medical costs, for example, that people may have to bear. So it's interesting with debt and budget, actually. Sometimes people have an aversion to budget because it feels so constrained. So once in a while when I meet clients, trying to plan for retirement, I talk to them about creating a spending plan so it doesn't feel like they're so constrained, So let's have a plan here so that you can manage your expenses.
That's all that it is, a plan.
Yeah, it's semantics, really. It's kind of interesting.
That's the new name for a budget is spending plan.
Spending plan.
Yeah, there you go. Now, there was this Credit Card Act that passed in 2009. Does that impact consumers?
Most definitely. It's something that's helped consumers. The way that most folks will see that impacted in their lives is if they're receiving credit card statements for one that they're repaying. What they'll see is different disclosures on that statement, namely disclosure that shows how long it would take them to repay that balance if they only paid the minimum payment
Got it.
versus an alternative payment that would be above the minimum payment.
I see.
Additionally, it provides some protections when it comes to interest rate increases and closures of accounts that would be initiated by the creditors themselves.
I see. And those are the initiation of closing of a credit card, for example, is not a desirable state for any consumer, right?
Right.
But the disclosure right from 2009 is great, because then if consumers aren't paying attention to how long it will take if you repay the minimum, that can be
It
pretty
can be
ugly.
difficult to understand, you know, especially if it's someone's first credit card. How much interest am I really paying if I only make the minimum payment? And I think it's a great provision. I just wish it was 10 years sooner.
Yeah, right, to get people to understand. So, no, let's actually talk about the bankruptcies. There's Chapter 7 and Chapter 13. And there's some standard costs applying with that. I mean, we're talking about the extreme here of not being able to manage debt, right? Are there standard costs in doing that? Do people have to see an attorney to?
Typically, you would utilize an attorney to file bankruptcy. You don't have to, but it's not really recommended because it can get complicated. And with a Chapter 7 bankruptcy, it's where all of your debt is discharged and you don't repay anything. And that it stays on your credit report for about a 10-year period. A Chapter 13 is more of a repayment plan. You repay a portion of your creditor debt. That stays on your credit report for 7 years, but it doesn't start until after the bankruptcy is actually discharged. So that could stay on your credit report. Typically, I usually say about 10 years for each. There are costs that are involved. There's both the attorney fee and a filing fee. It could typically range anywhere between $1,000 to $2,000, just depending on the person's situation, what kind of bankruptcy they're filing and all. And it's the last resort, you know, if somebody really wants to try to budget out their money and repay their creditor debts to their best of their ability. But if there's a situation where they just simply cannot, it can be reviewed as an option.
Sure. So really the first step is really managing your cash flow first, creating a spending plan, having cash reserves, making sure that you're aware that you can repay debt and its purpose in your enhancing of your life, as you had mentioned, Chad, earlier.
Absolutely. It's
Yeah.
actually a requirement that an individual comes to a credit counseling agency prior to filing bankruptcy. So their situation can be looked at and reviewed and just talked about, just to figure out what is their best option at that point.
And then one last question is debt management program. How long does that stay in someone's credit history?
That's a really good question. A lot of times when folks are coming in and they're exploring that as an option, they're asking, you know, whether or not that's going to have a negative impact on their credit score. We actually do not report information to credit reporting agencies, but the creditors that are included in the plan might elect to report the fact that their debt is being repaid through a debt management plan. That notation on someone's credit report is not factored into the FICO scoring models or the credit scoring models as a negative piece of information. So the fact that someone is utilizing a debt management plan is not going to negatively impact their credit score. And over time, it will help their credit score because, again, as we talked about earlier, it's addressing those two main issues with the credit scoring model, which is on-time payment history, and paying down those unsecured debts.
Great, very good. And I wish we had more time because you guys have been very, very wonderful about sharing information. So I want to thank Chad Reiflin and also Andrea Colline joined us from Consumer Credit Counseling of Rochester. Thank you again.
Thank you.
for your
Thank you.
time. And thank you, our viewers, for joining us today. I'm Nannette and it's about money.